I'm about to show you what could be the easiest, yet one of the most powerful portfolios you could use to build wealth, and is recommended by none other than the legendary investor Warren Buffett, who specifically stated in a letter to his shareholders to trust the long-term results from this strategy because they will be superior to anything else attained by most professional investors. So after seeing this, I came to the conclusion that if a blindfolded monkey can pick stocks just as well as experts, then a simple portfolio using index funds is a great option, which reveals the simple truth. If you want to beat the stock market, you need to avoid the cost of being human. In fact, one of the portfolios I'm going to show you in this video has averaged an annual return of 12.44% over the past 14 years, which means a $100,000 balance then would now be $531,000. And yes, past performance doesn't guarantee future results, but by watching this video, you are guaranteed the knowledge to go out and easily build your own portfolio to build wealth, which this video is completely free, and all it costs to watch this video is a few minutes of your time and a single tap on the like button below to help my channel with the YouTube algorithm. With that said, let's get straight to it by covering what is a two-fund portfolio. Now, a two-fund portfolio is simply an investment portfolio that includes only two funds, either mutual funds or ETFs. And for this case, it includes one domestic stock fund and one bond fund, where a domestic stock fund is pretty much a fund that includes a range of different stocks within your country, for this example, the US. Then a bond fund is a type of fund that includes different types of bonds in order to reduce risk, provide stability, and additional income. There are many benefits to using this type of portfolio, but one of the best reasons is that managing it is extremely easy because how much do you really need to change? In fact, an index fund like the S&P 500 automatically adjusts the top 500 companies listed on US stock exchanges based on their market size, so you don't have to do any of the work. And even better, with index funds, they have much lower expense ratios than actively managed funds, so long-term with this is even more cost-effective. And when it comes to rebalancing the portfolio, there's only two funds, so if you want a certain allocation, all you have to do is buy or sell more of one particular fund. This makes the portfolio extremely convenient for when it comes to risk tolerance because you can easily just reduce or increase the amount of stocks you have compared to bonds. For example, younger investors may favor more toward the growth, so they would have more stocks. Then for those in retirement, they might increase their allocation towards bonds for a stable income. The bonds are important, especially at the retirement stage, because they provide a level of safety and income that can help hedge against the volatility of the stock market. So with that said, with a two-fund portfolio, although you're only investing into two investments, your money is actually going to be placed in many different sectors, which will reduce your risk of losing money. For example, let's say you have $10,000 and you buy two stocks, $5,000 in each. If one of the stocks goes bankrupt, your account is now at $5,000. But if this were in the S&P 500, instead of just two stocks, you would now have 500 companies, and if one of them goes bankrupt, your account would only drop to $9,980. If you didn't know, when a portfolio drops 10%, in order to get back to the break-even point, it would have to grow 11%. Even worse, if it declines 90%, throw that thing in the trash because you're going to have to gain 900% just to break even. But by using an index fund like the S&P 500, the worst year it's had in the past 40 years was down 38%. But if you hold that long term, it's seen significant growth, and over the past 40 years, it's averaged an 11.6 annual return, and is what makes a two-fund portfolio a great option to consider. With that covered, let's now go over Warren Buffett's recommended portfolio. This portfolio is famously known as the Warren Buffett portfolio, which consists of the S&P 500 index fund and a US short-term government bonds fund. In fact, Buffett quote-unquote states the best thing to do is own the S&P 500 index fund, mentioning that for anything else, people will just try to sell you other things because there's more money in it for them if they do. Buffett is so determined on this recommendation for people that he even states he would not want to bet his life on even his own Berkshire Hathaway to beat the S&P 500 over the next 10 years. And going further, he even told the public that this two-fund portfolio strategy will be taking place upon his death. So with the portfolio, in regards to a short-term US government bonds fund, having a small portion of this in your portfolio is going to allow you to be protected from extreme downturns while still allowing the portfolio to embrace significant growth through stocks, which the exact investments Buffett recommends are the Vanguard's S&P 500 index fund, either the Vanguard Mutual Fund, VFIAX, or the ETF version VOO at 90% of an allocation. And then for the short-term government bonds, you're going to look at the Vanguard Short-Term Treasury Index Fund, either the Vanguard Mutual one, that is VSBXS, or the ETF version VGSH at 10% allocation. So if we look at the mutual fund version, which for those that don't know, this means that you're buying it on Vanguard's platform, unless you want to pay an unnecessary fee to get it somewhere else like like Fidelity, which, by the way, for my Fidelity fans, the two mutual funds for this would be FXAIX and then FNSOX. But by using Portfolio Visualizer, which I'll leave a link in the description below for you, from January 2010 to March 2024, the portfolio generated an annual growth rate of 12.44%, which means $10,000 would have grown to now being $53,172. On the other end, the worst year it had was roughly 17% in 2022, and the max drawdown at one instant was 22%, where individual investments that even I was a part of declined 80 to 90%, which is a huge reason how I learned to long-term invest in the stock market rather than trying to beat it. In fact, the popular quote that I love and hope you remember after watching this video is from the legendary investor Ray Dalio, who has said that trying to time the stock market is harder than competing in the Olympics. Besides that, when it comes to the ETF version of Buffett's portfolio, 90% in VOO and 10% in VGSH is very similar, but from the period of January 2011 to March 2024, it earned a 12.3% annual growth rate. And for those that don't know, ETFs can be purchased on pretty much any investment platform. Which, speaking of, if you are interested to start investing, you can get a guaranteed $60 or more of free stock when you deposit at least $500 through Webull, which I'll have a link in the description below for you to get started. With that mentioned, let's now go over the Bogleheads two-fund portfolio. Now, Bogleheads are followers of the investing principles of Jack Bogle, the founder of Vanguard, known for low-cost index fund investing and a long-term, disciplined approach to wealth building. Now, although the Bogleheads three-fund portfolio is more popular, their two-fund portfolio approach is similar to Buffett's, but just more broad. Literally meaning that because he says to get the total US stock market index fund and then a total US bond index fund. And although he recommends different allocations based on your position for risk, I'm going to show you a 90-10 allocation for this as well to keep things consistent for comparing. So with this portfolio, the Vanguard mutual fund is going to be 90% in VTSAX and then 10% in VBTLX. And based on this portfolio, since the time period of January 11 to March 2024, the portfolio instead grew 12.03%, which is slightly lower, but this means that $10,000 would have grown to roughly $45,000, and the worst drawdown was close to 24%, actually worse than the S&P 500. And then the worst annual return was in 2022 at close to negative 19%, where the previous portfolio was 17%. On the other end, if you wanted to do this with ETFs, you would have 90% in VTI and then 10% in BND, which, as I mentioned, index funds are extremely cheap, and for both of these options, they come at a 0.03% expense ratio. For those that don't know, the expense ratio is the cost it takes to own the fund per year, which means if you were investing $10,000, that you would only be paying $3, the price of a hamburger, a year in fees, just go on a lunch diet for a day. But this computed similar results with a 12% annual growth rate, and on Fidelity, this portfolio would be 90% in FXAIX and 10% in FXNAX. So now that you know exactly how two-fund portfolios work, let's now go on to comparing them with three-fund portfolios. This type of portfolio is simply the same as a two-fund portfolio using a domestic stock fund and a bond fund, but now it's going to add an international stock fund as the third. So an international stock fund is simply a fund that consists of exposure to companies based outside of the US. That way, with this portfolio, you are gaining exposure to all types of economic conditions. So with the Vanguard mutual funds would consist of a total stock market index fund, VTSAX, total international fund, VTIAX, and then bonds, VBTLX. If you wanted to take Warren Buffett's recommendations but still have an international fund, you could instead use an S&P 500 index fund, VFIAX, and then for US short-term bonds to use VSBXS. And then if you wanted to do this with all ETFs, it would be VTI, VXUS, BND, or with Buffett's approach with the S&P 500 and short-term bond fund, it would be VOO, VXUS, and VGSH. But in regards to the addition of international stock funds, this is an important topic to understand because, first off, when you are doing this, you are going to be exposed to more than 8,000 non-US based companies, with the largest regions being Europe, the Pacific, and emerging markets. In fact, some of the most popular companies that you may have heard of could be Toyota, Samsung, and Shell. Now, exposure to these areas are great for diversification, but there are things to be aware of because why else would Warren Buffett and Jack Bogle stay away from it? Well, as Jack Bogle puts it, international investing involves extra risk, ranging from currency risk and economic risk to societal instability risk. And then for Warren Buffett, he states that don't bother with international names, you really want to just bet on America. A big reason for this is because America's accounting standards are extremely transparent since they require financial reporting at a high level. The financial reports, such as quarterly earnings, are meant to bring confidence among investors and stability in the market when compared to many other international regulations. Another point to argue on why you may not need international exposure is because when you're investing into these large US-based companies, they also have operations that are scattered throughout the entire world. For example, Apple, Coca-Cola, McDonald's, and Nike are just a few companies that impact the entire world's economy, but they are US-based companies that have sales from many other operations throughout the world, which is a huge reason why most of the largest companies by market cap have exposure to the entire world, even though they are a US-based company on the US stock exchanges. In fact, Apple's revenue share by geographical region from the first quarter of 2012 to 2024 shows a range of 40 to 50% of their revenue coming from the US, where everything else comes from their foreign exposure. Coca-Cola for the year 2023 shows only 36% of their revenue came from North America, and besides McDonald's 14,146 locations in the US as of August 2023, the list of countries and how many restaurants they have in the entire world is just remarkable. So the viewpoint here is that if you invest into the S&P 500 or the total US stock market index fund, you are taking a significant part of the growth that is occurring in foreign countries. And believe it or not, since January 2012, the Vanguard S&P 500 ETF VOO grew at a 14.49% annual growth rate, where the international ETF VXUS was only 6.31%. Now, don't get too narrow-minded on this, because truth be told, over the past decade, yes, the S&P 500 has outperformed international stock, but the decade prior, international stock actually outperformed the S&P 500 majority of the time. And although past performance doesn't guarantee future results, by signing up on Webull and depositing at least $500, you are guaranteed a minimum of $60 or more of free stocks. So go check out that link I have in the description below. But in regards to a 2 or 3 fund portfolio, it's really a personal preference, because you may want to take Buffett's approach and bet solely on America because it's simple to have only 2 funds. Or you could add some exposure to international stock funds to increase your diversification and reduce the overall risk, but I would keep it at a minimum. And by the way, the goal of investing in the stock market should really be to not lose money, rather than what everyone thinks of it as, to make the most amount of money. When you truly try to outbeat the market and make the most amount of money from it, end of the day, you're actually not going to, and I can tell you from my own experience. With that said, if you are interested to learn more about 3 fund portfolios, or even investing as a whole for beginners, I've made free guides for you, linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.